Hello, everybody. My name is Tom Markham. I'm with Fortuna Capital Management. This is my partner, Mike Montana. And several days ago, we shared on LinkedIn and some other social media, we shared a photo and a message about a property that we just exited that had some fantastic returns that we enjoyed, 61% IRR and 171 times return on our initial investment. And we teased at the time that we were going to have some more detail on what we did to achieve those numbers. And so I want to spend a few minutes today going into some of the things that went into that deal that helped us achieve that. Our tagline is real estate investment simplified. And so we like to put out these videos now and then to just tell everybody, share information that we have learned along the way to help new investors, to help passive investors, people that are looking for their first deal, their first syndication, or their 10th syndication. Just put out any information that we can that might be helpful. So today we wanted to talk a little bit about this deal, a little teaser for down the road. This was our first pretty good size multifamily deal, and we learned a lot from it. So we're going to have some videos down the road on some of the other things that we learned. But for today, we just wanted to concentrate on a couple of the main elements that we think really helped lead us to success with this deal and help us achieve those phenomenal returns. Before we get to that, I thought I'd turn it over to Mike for a few minutes to give us some background, a little bit of background about the property and about the deal. Mike?
Yeah, great. Thanks, Tom. So at the time we entered into this deal, Tom and I had already owned a duplex and a fourplex, but this was the first kind of larger full-scale multifamily property that we bought. This was back before Bigger Pockets and podcasts, kind of all of those virtual content formats that were out there teaching people about investing in real estate. You know, really at the time, our plan was kind of kids college education, our retirement program. Hopefully this would supplement our retirement fund and provide us another source of income. The main thing we really looked for when we were buying a property at the time was cash flow. You know, what was the break-even point from a vacancy standpoint or an occupancy standpoint that made sense to us? And that's really kind of how we looked at it. We really thought real estate at the time, we were pretty naive and we thought real estate just appreciates. So we didn't truly understand the concept of forced appreciation or value add to a property. We'll talk a little bit about how we did that, but we didn't understand that concept at the time. We just jumped in both feet and started. Tom, maybe you tell them a little bit about the property itself, what it was.
Yeah, and I'll just go back on what you said there a little bit. I mean, I think we looked at cash flow. You know, we didn't want to dig into our pockets, so we wanted to make sure this investment wasn't going to get into our personal funds at all. And so we looked at that, and again, we just assumed that it was going to appreciate. So that's how we thought we were going to make money on this deal. But a little bit about the property. It was, at the time, it was 14 units when we bought it. It's a C-class property in an A-class area. It's a nice, right off a main strip in Avon, Indiana, which is a suburb of Indianapolis, fast growing. And this was back in 2003. The economy was humming. Everything was going great. You know, we just, honestly, we thought we were hitting a home run right off the bat. You know, we could sell this thing in a couple of years and make a bunch of money. We ended up making some money, but it took us a little bit more than a couple of years. Yeah. So, Mike, you want to share a little bit about some of the things that we did that helped us ultimately hit a home run, I think?
Yeah, sure. So you're right, Tom. I think at the time we didn't want it getting into our pockets because we didn't have any money, right? I mean, we were pretty young and just getting started. We were actively looking for a deal. This is kind of how it happened. We were actively out looking for a larger multifamily property. We'd already had some success in the smaller multifamily deals. We knew we wanted to scale a little bit. So we actually found this deal on the MLS, ironically, and this was before we even knew what LoopNet was or Crexi or any of those things. It was just the plain MLS listed by a residential broker. I think we bought it on contract at the time, which allowed us to get some good terms. And maybe you can explain kind of, Tom, you remember kind of what those terms were when we bought that
Yeah, basically, I mean, I think we've kind of boiled it down. There are kind of five things that we did that really helped us do well on this. And the first thing was, yeah, we bought this on a land contract,
Yeah.
and it allowed us to get some really good terms. So first off, we were able to borrow a good part of the down payment. So the seller was financing the biggest part. They did want some money down, and we were able to borrow that down payment, a significant portion of that from some people that we knew that were basically investors, but we wrote it up not as a return they were going to get, but as a basically as a second mortgage, and they were willing to take second position on that. Also, part of the down payment, we got some credits at closing for the typical ones for real estate, taxes and things like that. But we also got some interesting credits, and Mike can go into
Yeah,
a couple of those.
you're right.
Yeah.
Exactly. I think as you and I were kind of reminiscing about the deal, it was very creative. We can get into that maybe in a later video, but one of the funny things we did is we took the broker actually took part of his commission as a Corvette from the seller. So they traded him a Corvette for part of his commission. And then he took the other portion of it from us in a short-term 6-month loan, which we actually paid just off cash flow for the first 6 months, directly to the broker, right?
Yeah. So it was creative. A land contract, you're going to get an opportunity to be way more creative than with bank financing. I think it's suffice to say. The other part of that contract, part of the terms, were the way that the seller, they really wanted to achieve some cash flow. They had a price in mind. They had all kinds of things. And so we said, okay, let's see how we can make this work. Well, part of the way we made that work, in addition to the other creativity that we did, was the loan was actually amortized over 33 plus years, came out to a 3.4% interest rate. And at the time, the 10-year treasury was I looked it up, it was 3.9 to 4.05. And it's 1.4 now. It's right around there. So our interest rate, if we would have gone to the market, would have been probably in excess of 6%, I would think, something like that. So, we definitely got some good terms on that note, writing it up that way.
Yeah.
But did you have any? Sorry, do you have
No,
anything?
yeah, we definitely did. That was one of the things that really made the deal work for us.
Absolutely. The second thing that we did was we operated this ourselves. Obviously, management is important of a property like this, and we had some experience at the time. This was the biggest property to date that we had, but we learned a lot about management kind of on the job. We took a chance again, as you said earlier. We jumped in with both feet, and we did it. Certainly on the management side, a couple of things that we did was we looked at, could we bump the rents, which we were able to do that. I think that the seller had not been consistently doing that. So we saw a little bit of opportunity to do that. We kept occupancy high. And part of that was we probably were still under rented a little bit, but it was important for us, again, what we talked about earlier, keeping that cash flow and making sure we weren't digging into our pockets. So we really focused on keeping occupancy high. And we, again, before we even knew what a RUB was, we were toying with that. So the way the building was set up, the owner, as the owners were paying part of the utilities. So we toyed with some versions of that, of how we could either pass that on. We actually kind of did a reverse thing. We started paying more of the utilities and charging a higher amount than what we were actually paying to the tenants. The tenant base, it worked out well for them because there were reasons that sometimes it was tougher for them to go and get their own service hooked up. So we did it for them and basically charged them a premium. So I don't know what the opposite of a RUB is, but we kind of did that somehow, and then we toyed with things like that over the years. But all of that really was some self-management that we did, and really helped the building cash flow well. And we kind of did the 61% IRR. It looks good, and there can always be ways that you can manipulate things, and certainly one of that things was self-management. But we went back and ran the numbers, and even had we put a 10% management fee in there, to have someone do it, our IRR was still pretty high. We still estimate that it was in the high 30s, probably around 38%. So we still did pretty good on the building, even had we had someone else manage it for us, I think.
And then if you remember, one of the other things we were able to do with that property, Tom, is, that debt finally ran out, that land contract finally ran out. We had to refinance the property. We refinanced it a couple of times, and ultimately we took $400,000 out of that property that was done in refinancing. So it was a non-taxable event. We were able to take that money and then go buy other assets, reinvest that in more real estate, which really kind of juiced our value or our return on this whole property.
Yeah, that's not even factored in the return. That's kind of the gift that keeps on giving.
Yeah.
But that was certainly something that we did that helped us be successful. We looked for some opportunity to make some improvements. We had kind of an oddball unit in there that was kind of big and clunky and set up weird. And so over the course of several years, that one large unit, we divided it into two and then ultimately into 3 units. And so that really bumped the value of the property up, and obviously the cash flow. But that was something that we hadn't even really thought about going in. It was just something opportunistic. As we got in there and operated the building, we realized this was something that was probably going to help occupancy remain high, and not only that, it was going to add a lot to the top line as well. Anything else to add on that, Mike?
No, I think, kind of closing the whole the whole scenario out, or the whole deal out, is, ultimately we rode through a pretty rough economy. We had this for 18 years, so we lived through the 2008 range, and property values went down dramatically, and then they come back up, and frankly, we just kind of looked at the cycle this year and said, hey, it's kind of at the top, or it's headed towards the top. We don't know where that is, but this is good enough for us, and let's do it. And so we decided to execute an agreement to sell the deal. We actually sold it off market. We didn't list the property, right? A broker brought us a buyer that was interested, or a couple buyers actually interested, and we agreed to kind of sell at what we thought was a pretty high point in the cycle.
Yeah, who knows where we're on the cycle, but we certainly know we've been in some low cycles, so we know this is a pretty good one. So it was a good time for us to get out. So just to sum up, really quickly. So the 5 things: we bought it on contract, we operated it ourselves, we did make some improvements, and I would add to that, toward the end of the and within the last couple of years, as we did start learning about forced appreciation, we definitely made some improvements to the building where we did force that appreciation. We were able to bump that value up substantially by increasing some rents, doing a few things to the building. So we did some things that we didn't know about early on, and we ended up learning more and even being able to add more value to them. Then we refinanced it to pull some money out and move that to another deal, another thing that really helped us be successful. And then we sold it at a good point in the cycle. So those 5 things we think were the really important elements of this deal that really made it successful and gave us some pretty good returns.
Yeah. So hopefully this was valuable. If you watch this video, we hope you got something out of it, learned something out of it. We intend to post some future videos. I think we'll break this deal down in a little more detail, post some more details about things we learned, kind of buying on contract. We'll go into a little bit more of the details of how we did that. Ultimately, then talk a little bit more about self-management. We think we've set ourselves up very well to succeed in multifamily real estate by learning that process. So stay tuned over the next few weeks. You'll see some more thumbnails come up with videos from Fortuna Capital Management. And ultimately, if you have interest in real estate, reach out to us. Connect with us on wherever you found this video: LinkedIn, Facebook, Instagram, whatever that is. We'll leave our contact information in the show notes, or the video notes. And we'd love to have a conversation with you about if you have interest in investing in real estate, whether that's passively or actively. We're happy to just have those conversations and network with folks. At the end of the day, our goal at Fortuna Capital Management is real estate investment simplified. Hopefully we did that.
Thanks for watching, and we look forward to hearing from you all soon. Thanks.